अरे मौका बिना फिक्र के जीने का मिल गया। 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया। जो आने वाले कल की प्लानिंग करके चलते हैं, सोच समझ कर उनको इन्वेस्ट करने का सलीका मिल गया। 12 20 और 80 से पीस ऑफ माइंड मिल गया। म्यूचुअल फंड में इन्वेस्टमेंट करने का तरीका मिल गया।
Finally balanced, active, passive, index or managed, सभी का मिल गया।
क्वांटम के म्यूचुअल फंड, क्वांटम के 12 20 और 80 से इन्वेस्टमेंट करने का तरीका मिल गया।
क्वांटम म्यूचुअल फंड के 12 20 80 यानी 12 20 80 एसेट एलोकेशन अप्रोच ने इंडिया को सिखाया इन्वेस्ट करने का सही तरीका। और जानकारी के लिए सर्च करो क्वांटम 12 20 80 एसेट एलोकेशन। म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
Good evening, everyone. My name is Neeraj Kotian, and I will be the moderator for today's panel discussion. I'm part of customer interaction team at Quantum Mutual Fund. A warm welcome to all, and thank you for taking your time on Wednesday evening and joining us for the session. We'll request everyone to use their headphones for better audio clarity. Session will start with presentation of 30 to 40 minutes, and then it will be followed by Q&A. You all can post your questions in the chat box post the presentation. So looking back on the whirlwind of 2023, from escalating tensions between Ukraine and Russia to a surge in oil price and profound geopolitical shift, despite this, India remains resilient, positioning itself as the next emerging power. As we face upcoming elections and grapple with global socio-economic challenges, new hurdles in the form of recession and inflation emerge. But what's come next? While the future remains uncertain, we believe in the power of a solid data and in-depth research to not only prepare for the days to come, but also to seize investment opportunities. Hence, today our 4 panelists will share their perspective on macroeconomic trends and provide valuable insights into the asset class of equity, gold, and debt. Also, they will answer questions like, how have different asset classes performed in the year 2023? What are their expectations from the respective asset class in the year 2024? How can you build an investment portfolio that can withstand uncertainty and grow wealth in the long run? So before I hand over control to our panelists, let me introduce them to you all. Our first panelist for today's evening is our CIO, Mr. Chirag Mehta, who has over 19 years of experience in the financial market. He is specialized in the field of alternative investment strategies. Chirag is a qualified chartered alternative investment analyst and has also completed his master's in management studies, MBA in finance. He is currently managing 5 funds, largely in the field of alternative investments, which includes gold fund, multi-asset funds, an equity fund of fund, also ESG funds, and a small cap fund. Chirag was named amongst the top 40 managers globally under the age of 40 by CTY UK 2017. Our second panelist is Mr. Pankaj Pathak, who has over 14 years of experience in fixed income investments and research. He joined Quantum in 2013 and at present is fund manager of Quantum Dynamic Bond Fund and Quantum Liquid Fund. Pankaj holds a postgraduate diploma in banking finance from National Institution of Bank Management, Pune, and is qualified CFA. Our third panelist is Mr. George Thomas, who has over 7 years of experience in equity research across multiple sectors. He has been part of Quantum since 2016 and at present is Associate Fund Manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. George has completed postgraduate diploma in management finance and from IMT Ghaziabad. And our fourth panelist is Ms. Ghazal Jain, who has over 7 years of experience in the field of finance and alternative investments. Over her career, she has gained multi-asset exposures by helping managing the gold ETF, equity fund of funds, and multi-asset funds at Quantum. She is a regular contributor to leading finance and business dailies. Ghazal joined Quantum in 2019 and has completed her MBA in finance from the School of Business Management, NMIMS, Mumbai. Without taking much time of yours, we'll request our speakers to take ahead the sessions. Over to you, Chair.
Thank you, Neeraj, and thank you everyone for joining us today. Today we will look into what brings, what things are in store for 2024. We have seen fabulous performance from equity markets in India. We have seen debt markets also stabilizing again, and now we are seeing some returns given bond yields more or less have peaked. And gold has also done well. So what's in store, how you navigate the markets next year, how do you position your portfolio is what we will discuss today. So let me give you some macro trends that we are seeing that will underpin the markets going forward, not only 2024, but much ahead into the future. So if you look at the India GDP growth, we all kind of worry about global world slowing. There are things happening in India as well, which will impact economy and markets. But the most important thing that we believe that one should look at is that over the long run, India has grown at 6.2% real GDP growth rate, despite whatever happening in India, be it a single party government, be it the coalition government. And what all has not happened in India. We have seen Prime Minister assassination, we have seen flood, famines. Recently, Chennai, we have all witnessed the cyclone and the aftermath of that. All has been part of India, all these 40 years that we have seen. And despite that, India has grown at 6.2% real GDP growth rate for over last 40 years. So even now, when you worry about elections, don't worry about that. Because India has its own internal consumption dynamics, which leads to this growth rate, and we don't see that altering. So people may come to you and say that India may grow at 8, 9, 10%, or cause, on the other end, a worry in terms of India may grow at 4 or 5%. There could be years when you see such touch points at 8, 9%, or even 4, 5%. But on an average basis, India will grow at 6.2%. Our estimators for next couple of decades, 10, 20 years, India will grow at 6.5% real GDP growth rate. And there is nothing that will alter that view. India could grow higher, but we need a lot of things in place before it could grow at a higher growth trajectory, like land reforms, labor reforms, infrastructure built up, etc., for it to grow at that higher pace of growth. Also, we need capital. And if we have mixture of all that, we could edge higher in terms of growth. But until those things come along, we will grow at 6.5% real GDP growth rate for next couple of decades. So given that we are approaching elections over next 6 months, no matter what happens, of course, we've seen the state election results, which have been some form of foretelling in terms of what happens in the national elections. But even despite whatever you read and hear, assume that India will keep growing at 6.5%, which in today's world is a very respectable growth rate. Moving ahead, what we have seen is there have been different governments, and different governments have done different policy making, which has led to certain growth trajectory that we are in. So we have seen some infrastructure building over the last few years. There have been trade liberalization. We have been working over that since last couple of decades. We have easing FDI norms, which largely happened during the last tenure of NDA. We have seen divestment from PSUs and financial inclusion become a big economic agenda driven by Aadhaar of the previous UPA government. So we've seen that governments have built up on reforms. Some have been slower paced, some have been fast paced. But all across, we have seen that, each contributing to the foundation that will help India grow for next couple of decades as well. Like, for example, 1999 to 2004, what we saw was starting to build up of the infrastructure with the Golden Quadrilateral project. Some PSU divestments happened then. There were lowering of trade barriers, which helped India grow from 2004 to 2014. The biggest thing that was laid down was the Aadhaar program and the start of GST regime. Both were very, very good. Another thing that was very impactful was Manrega, where, that lent jobs to so many people in rural areas, and that helped revive growth in the rural areas as well. So fast forwarding to 2014 till 2023, the NDA regime, we saw financial inclusion, which was furthered because of the JAM Trinity that we saw, Jandan, Aadhaar, and mobile, that really facilitate the financial inclusion and stopping of leakages through the direct beneficiary transfer. We had the insolvency and bankruptcy code that really helped overall. There was a RERA Act, which was a booster for real estate as a sector. There's corporate tax cuts that also helped, companies to set up and become competitive from a global tax perspective. There was GST implemented on a wider level. There was a monetary policy framework that saw changes. So all this has laid a foundation, a good foundation for us to keep growing at that 6.5% real GDP growth rate. One thing that we think is very, very powerful and works in favor of India is India, we think, is an inflection point from a per capita GDP. If you see the green marks, the green arrow marks on the chart, these are levels for various economies that we have seen, various countries that we have seen, that when they achieve that $2,000 per capita GDP mark, from there the growth continues significantly, or there's a hockey curve that comes into place, and growth kind of accelerates from that point. And if you see India, the black line at the bottom is exactly at that point. We have surpassed a $2,000 GDP per capita, and when any economy has crossed that, growth has generally accelerated, barring what we saw for Vietnam. Vietnam was again a slow-paced growth as opposed to other economies like, for example, China, Malaysia, Thailand, which saw a significant acceleration in GDP growth. What really happens is, it's a change from sustenance to discretionary spending. When people have money beyond a certain mark, they try to spend it on many other things because they have really taken care of the roti, kapra, and makan that we all strive for. And once they have all the necessities in place, they kind of start discretionary spending the additional income that they have. So when that income surpasses that $2,000, that is when they start spending on various things like what we are seeing in India even today. People are spending on travel, people are spending on various discretionary items, be it gold, be it mobile phones. So there is a lot of discretionary spending already that we are seeing in India. And from here on, if the other economies throw some clues, probably we will grow significantly from here on. One more thing that we see about India is that India's trade with the world is rising. So we have seen so many themes, right? Themes have always been part of India's story. We had the brick mania from 2004, 2005 to 2007-8. That was an era of brick. Then we saw the Fragile Five, where India had seen some nervousness. And now we are seeing India benefiting from the China Plus One story, where global companies are looking at setting up base as an alternative to China, and also ensuring that the supply chains don't get disrupted because of the policy making they see in China or uncertainty surrounding policy making in China. So overall, its export of goods has been picking up. Also, globalization of services is playing a unique opportunity for India overall. So both we have seen an uptick from a goods perspective, from a services perspective. What really needs is certainty in policy making, some infrastructure built up, which both we are seeing to some extent. And if both continue, probably we'll see the growth in both areas in terms of exports of goods and exports of services. Also, if you see, we have a demographic advantage. It could lead to, if we don't create jobs, probably it could become a nightmare. But until then, we are optimistic that this demographic advantage can very well work in favor of us, especially when the global economies are seeing a fast aging world in their economies. So if you see the two lines where we have compared India and China, if you see the India in China, when their population peaked, until then, we saw a big growth into the 10 years prior to the population peaking. If you see, the era of 2000s was a great year for China from a growth perspective, 1990s to 2000. And if you see India, the yellow line, the population will peak in 2030. So probably 10 years before that is usually when we see a sharp up move in growth, and which is what we are witnessing even today. When the global world is struggling, India is still growing at a fast pace. And we think that pace will continue because India will benefit as being a recipient of jobs from these fast aging global economies. And therefore, India should benefit because it can serve as a driver of missing jobs in these global economies. So next 10 years could be probably before the India's share of working age population peaks by 2030, we could be in a good trajectory for growth, or at least over next 7 years that we have further before that growth peaks. So even with the population structure that you see, we have a lot of population in the working age brackets, which will keep inching higher over next 7 years before it peaks. And as we have the younger demographic profile, probably that is where the consumption happens. So higher share of working age population can also translate to a higher consumption growth because these are the years when people consume a lot. Whereas in the developed world, they have an aging population and therefore the consumption declines. Whereas India is a bigger market for consumption growth, and therefore you could see not only consumption benefiting, but also production setting up closer to where the market is. And therefore, when people are looking for alternatives to China, they could also set up base here for serving the Indian market, which is a fast growing market per se. If you look at the corporate balance sheets or bank balance sheets today, they are very, very healthy. So the first chart on the left-hand side is corporate debt to GDP. It has come down significantly. It is at the levels that we have not seen ever since 1999. So over the last 20 years or so, we are at the best levels from a corporate debt to GDP ratio. It stands around 0.8. So there has been a lot of deleveraging that has happened, and a lot of strong cash flows these companies have generated has also allowed this deleveraging to happen. If you see the chart on the banking sector, or if you look at the chart on the right-hand side, corporate return on assets, they have been moving higher. So ROA, ROEs, ROCEs of companies, return on capital, has been moving higher, which is again supportive of earnings growth in the economy. As their revenues grow, they are making more returns on the assets per se. So the revenues are translating into the bottom line of companies. This is what it shows. Probably as we have seen in the previous cycle from 1999 to 2007-8, before it peaked, it really went from 2% to about 7%. We are currently at closer to about 4%, 4.5%. Probably it has further runway to grow. So there could be an earnings story yet unfolding into the Indian corporate arena. Coming to the banking sector, if you see the chart on the left-hand side at the bottom, the banking sector NPAs have been improving. It's not at the levels that we have seen in the previous cycle where it bottomed around close to 2%, 2.5%. We are still at around 5%. So probably we could see further because there is no stress in the banking sector yet. We have seen a declining NPAs. Probably it could decline further from here, these levels. Also, if you look at banks' capital adequacy, they are at levels we have not seen over the last 5-7 years and have been improving significantly. So capital adequacy, banks are in a comfortable position. So if there is a revival in capex and there is to be more lending, banks are comfortably placed to fulfill that lending given the capital adequacy where it stands today. Also, one supportive element for the Indian economy that will give some confidence to the global players to come and set up shops in India is the infrastructure. Infrastructure has been expanding really fast. If you see the rail network, because government has enough revenues from the GST and tax collections. That is, they are pumping it into the economy, investing in capex and deploying this infrastructure so that it could help the next level of growth in the economy. So the rail network has been increasing. If you see the state highways, the national highways, they have been increasing. So not only at the central level, even at the state level, there have been investments being made. If you see ports cargo handling capacity, that has also been inching higher from what it was in 13-14. It's grown up by 83%, and the turnaround time at ports has been declining significantly given we have invested in that capacity building. If you see what was around 4 to 4.5 days has come down to 2.5 days now in terms of the turnaround time. Probably it's not the best out there in the global markets, but I think as we invest further, we could see that turnaround move faster. So from a logistics cost perspective, we have seen that there has been improvement. Only the warehousing cost is a bottleneck, which I think the government will address sooner or later to help more capacity or more attract more investments from global firms that want to shop as an alternative to China. So with that as a background, we think that you should diversify and build a robust asset allocation, and we will see into each of the asset classes how they will behave in the next year from the fund managers who manage these assets for you. So if you look at what we say, that asset allocation needs to be very, very simple, something that you can understand and you can tweak based on your circumstances. So you need to have a safety net, an emergency corpus of at least 12 months. If you're not comfortable with 12 months, or if you think that's too, if you're young and you think it's too high, you could have anywhere between 6 months, 24, 36 months, anything that you feel is safe. Build that safety net, emergency corpus as we call it, and then whatever money you have left, split it into 80 into equities and 20 into gold. Gold is a good diversifier that helps you diversify the risk from other asset classes. And 80% is a growth block, given India is a growing economy. And if you want to beat inflation and have aspirations, really equity is a place that will help you achieve your goals. So 80 into equity and 20 into gold is what we would suggest. And this is a very simple, beautiful asset allocation strategy. We have seen it work in very different market scenarios, be it the bull runs or the bear markets of global financial crisis, COVID crisis, etc. This has worked beautifully. And the simplicity is so great that it can be tweaked to your own circumstances. So if you want lower equity exposure, you can lower it. You need a higher safety net, you can increase it. So you can tweak it based on your circumstances and build your own asset allocation. This is just a guidance. You can tweak it and build your own asset allocation, but we think asset allocation is paramount to achieving a great financial journey for you. With that, this is how we can build a diversified, a balanced portfolio of debt, equity, and gold. You could build it either the active way or the passive way, whichever you think works for you. You can diversify within the equity component into various kind of offerings like long-term equity value fund, ESG fund, small cap fund. On the passive side, Nifty fund of funds, or be it the ESG fund on the passive side. You could build it the way you want it. And we will suggest that you build it the active way, because we think that Indian markets have not really matured enough. There is still information asymmetry, inefficiency, and therefore there is scope for active to outperform passive. And therefore we will suggest you build the active way, but it is up to you, your choice in terms of how you want to build it. With that, I will invite Pankaj Pathak to give you the fixed income outlook. Will be followed by Ghazal Jain on the gold outlook, and then the equity outlook by George. Thank you. Over to you, Pankaj.
Yeah, thank you, Chirag, and thank you everyone for joining us this evening. Now, as Chirag mentioned that we should have asset allocation, and part of that, or part of starting our journey of investment, first we should look at building emergency corpus. And as the term suggests, it's emergency. So that means first thing we should look for is safety. So you should keep at least 12 months or whatever suits you. Somewhere safe. It could be if you want to put it below your mattress or in your saving bank account, or in our case, we can suggest that you can put it in debt mutual funds. And in terms of that, we can look for liquid fund kind of category, which are one of the safest in that entire bouquet of products that mutual funds offer. Next slide, please. Yeah, so now with that, I can just give you a small brief about quantum liquid fund. As we said that we should be looking for safety in this kind of product, and that's what we try to achieve through our asset allocation in liquid fund. So in quantum liquid fund, our paramount focus is on keeping the credit and liquidity risk to minimal levels, and the interest rate risk, which is more dependent on the duration of the instruments that you invest in, that is already capped. There is a mandatory cap of 91 days of the debt instrument. So we cannot invest in any debt instrument which has maturity of more than 91 days. So that risk is capped. For the credit and liquidity risk, we invest only in government securities and top-rated public sector companies which have some government backing. So in a way, it's a sovereign and quasi-sovereign kind of portfolio what we have. So minimal credit risk and very high liquidity in the fund. There's no investment in private corporate risk. Other than that, means whole idea of this fund is to provide liquidity. So you can have full liquidity. There is a instant redemption facility as well, up to 50,000 rupees, where you can get the money in your bank account instantly. So there's one product where you can maintain your emergency corpus. Now, if you look for the liquid fund over the last 2-3 years, when rates were low, when RBI has reduced the rate after COVID-19 crisis, the return on liquid fund has declined that time. But over the last 1.5 years, when RBI hiked the interest rates, now returns have also come at par with what you are getting at many other places, and significantly higher than saving bank account. So again, this has become a attractive proposition for many of the investors who are looking for debt allocation. Apart from liquid fund, there are long list of products in the fixed income space. So before going into what we should do with, say, for other fixed income allocation for investors who want that allocation, let me give a brief about the fixed income market and how we should approach the fixed income market over the next 1-2 years. So the broader theme is that interest rates are near peak. Now, how we should look at it is, so when we were coming out of COVID crisis, central banks and governments, they provided a lot of stimulus in the economies across the globe, including India, where central banks cut the rate, pumping a lot of liquidity. But as we coming out of COVID crisis, there was a bout of inflation across the globe. So especially in the advanced economy, that was much higher than many of the EMs. Like in US, we have seen inflation peaking around 9%. So that's a significantly higher than what they target to achieve, which is 2%. And many times they failed to achieve that target in the last decade. So that forced central banks to hike rate, and they were hiking rate for the last 1-2 years. But now we believe that rates are near peak, and most likely next year we'll see many of these central banks, including US Fed or European central banks, Bank of England, maybe cutting interest rates, and that could be significant drop in interest rates over the next 1-2 years. Next slide, please. So similarly in India, again in India also we are seeing inflation coming down from its peak, though we never had that kind of inflation differential what many of the advanced economies witnessed. There was inflation spike because of food prices, especially vegetable stocks in between. But if you look at the core inflation, which excludes this volatile component, the volatile food prices, that has been at the higher end of the RBI's threshold, around 6% for most of 2020-21. But recently in this year, we have seen core inflation coming down very sharply. and now it's very close to RBI's target of 4%. In our estimation, probably we'll see core inflation going below 4% over the next few months, and probably remain below 4% in the next year. So the drop in inflation will probably reduce some pressure from the RBI. They have been also fighting inflation for most of last 2 years. So if that pressure eases, bond market, maybe RBI will not cut rate, but this will be big positive for the bond market as the inflation risk premium. So whenever we see high inflation, the market tendency is to add some risk premium. So we see higher yield spread between the repo rate and the longer term bond yields. And as inflation comes down, this spread can shrink. And when yields drop because of that, that could add to bond prices. So bond prices could move higher because of that. So again, I think monetary policy, both from global and the domestic side, looks favorable for the bond market going into 2024. Another big dynamics which will probably play out in Indian bond market over the next 1-2 years is about the demand supply dynamics. So when COVID happened, the first response was that fiscal deficit widened, and fiscal deficit widened to more than 9% of GDP in FY21. That was the COVID year. And thereafter, government has been on the fiscal consolidation path. And this year, the fiscal deficit target is 5.9% of GDP. Now, what is fiscal deficit? This is the gap between the government's revenue and their spending. And the term deficit indicates that their spending is higher than the revenue. And how they fund this higher spending? Through borrowing, right? So if fiscal deficit is going down, that will also reduce the borrowing from the government. So our expectation is that for the next 2 years, probably we'll see lower supply of government bonds than what we had in the last few years, and especially in this year. So this orange bar, what you see, that shows the level of supply in rupees trillion for the FY24-25 and FY25-26. So there could be significant drop in net supply of government bonds over the next 2 years. While on the other hand, we are seeing pickup in demand for government bonds. So one, because of this financialization drive, what we have seen, insurance, pension, provident funds, their AUM has been growing at a significant pace. And that's kind of adding to demand for government bonds that has been rising very sharply in the last few years. And apart from that, we had a big positive announcement coming in September, which was JP Morgan, which kind of provide a widely followed EM bond index that included India in its global bond index. So India will be part of JP Morgan GBI EM index is starting June 2024. And given the size of Indian bond market, we are getting maximum weight of 10% of the total index. Now, the total AUM following this index is close to $250 billion. And 10% weight suggests that India can attract somewhere around $25 billion because of this index inclusion over the next 1 and 1.5 years. So the index inclusion will start with a 1% weight in June, and every month they will keep on adding additional 1% weight till we reach 10% index weight by March 2025. So actual passive flows will probably start from June, but market doesn't wait, right? So active players will start front running the passive flows, and probably we'll see flows coming in early part of next year. So increase in demand and lower supply, that's a very favorable demand supply mix for the bond market going into 2024. So this can drive yields significantly lower. So overall, if we have to just summarize what we presented in the last 2-3 slides, that one, we have a falling interest rate. Our interest rates are significantly higher than the inflation or the expected inflation. So we have a very high positive real rate, which is in north of 2%. Globally, interest rate cycle is about to turn. where interest rates hikes are over and they are about to start cutting interest rate in 2024. And this entire demand supply dynamics led by bond index inclusion. So all this presents a very favorable backdrop for the fixed income market going into 2024. And we expect maybe RBI will keep on hold in terms of interest rates, but the risk premium can shrink significantly, and that can give some capital appreciation to long-term bond. So we are reasonably bullish on long-term bonds at this point. And that's now the next question is how to position for this bond move. So best way to do that is through dynamic bond fund. Now the nature of dynamic bond fund is that this has a flexibility inbuilt in this strategy. So the flexibility is that we can change the portfolio positioning as per the market conditions. There is no boundary in terms of what kind of duration we take. In quantum dynamic bond fund, we have kept the other two risks, the interest rate, the liquidity and the credit risk to minimal level by capping the credit profile. So we invest again in only government securities and AAA rated PSUs. We're not taking any credit exposure, but we do take interest rate exposure, and that's the nature of the fund, that we adjust the duration based on the opportunities in the bond market or based on the interest rate outlook. So whenever we expect interest rates to go down, we extend the maturity and invest in longer duration bonds, which are more sensitive to interest rate changes. So when interest rate goes down, bond prices move up, and longer term bonds benefit more than shorter term bonds. And vice versa, when we expect interest rates to move up, that time we invest in shorter maturity bonds and play defensive. So now this flexibility is an advantage given the overall uncertainty in the entire world. Anything can go wrong. So I think dynamic bond funds are better suited at this juncture in the fixed income space. So that's all from my side on the fixed income. With that, I'll hand over to Ghazal to discuss about gold now. Thank you.
Thanks, Pankaj. Good evening, everyone. So now coming to the portfolio diversifying part of your portfolio, which is gold, which we think can be taken care of through exposure with quantum gold ETF and quantum gold savings fund. So what is a gold ETF, or what does quantum gold ETF do? It's a passive investment instrument. It invests in physical gold of very high purity on behalf of the investor, and it aims to track the domestic physical gold price. One quantum gold ETF unit is approximately equal to just 0.01 grams of gold, and these units are listed and traded on stock exchanges, which offer investors the flexibility of stock investments and the simplicity of gold investments, I would say. So I think now coming to the outlook. So if we just recap, 2023 was an eventful year. Markets have witnessed everything from high inflation to monetary tightening by global central banks as well as the RBI, erratic monsoons, geopolitical tensions in the Middle East, and through it all, of course, equity markets, domestic equity markets. Though the domestic momentum was really good, we were vulnerable to these, external developments and shocks. And if you see, gold proved to be an effective portfolio diversifier, doing well almost every time that equity markets when equity markets took a beating. So the best performing asset class of 2023 definitely was gold, but it also proved to be a good portfolio diversifier, which is where the 12-20-80 logic, or the asset allocation logic in general, actually proves itself. Moving on, if we look ahead, so geopolitical tensions with the ongoing Russia-Ukraine war and the Israel-Hamas conflict and the recurring US-China tensions, the risk assets or equity markets, if I may say, will stay vulnerable to escalations in 2024. As such, we can expect some sort of a structural risk premium to get embedded in gold prices. Adverse impact of these geopolitical developments on supply chains and commodity prices could also push up inflation. Similarly, the deglobalization trend, which has been underway post the pandemic, that is also expected to keep costs of goods and services elevated. And in such an environment, gold, which is considered a store of value, can be expected to increase in response. Also, we have the de-dollarization trend, the trend to diversify away from the US dollar, which was, fueled recently fueled by the Russia-Ukraine war and continues to be fueled by ongoing geopolitical risks. So all of this, will keep pressure on the dollar and again, help gold prices. Moving on, domestic gold prices are derived from international gold prices, and international gold prices are particularly sensitive to developments in the US economy and what the US Federal Reserve or the US Central Bank really does. So currently, since like mid 2022, the Federal Reserve has been on a tightening phase of monetary policy, which means it has been increasing its interest rates. All of those interest rate hikes are now starting to show up in terms of we're seeing, some signs of the US economy cooling off. Some sort of a growth setback or an economic slowdown is, soon expected to, show up for the US economy. And the world is kind of bracing for that, thing, for that development. And on the other hand, we have US inflation. There has been a disinflation momentum, but that's mostly been, with headline numbers really coming down because the pressure on supply chains and commodity prices because of the Russia-Ukraine war. I mean, that kind of has moved out, and that has helped definitely cool inflation down. But if we see core inflation numbers in the US, they are also cooling down, but at a much slower pace. And the expectation is that while inflation till now the Fed has really managed to bring it down, going forward it's going to be a little sticky and the Fed could find it more difficult to bring it down. So overall, the situation for 2024, I mean, is probable, highly probable, is a stagflationary kind of situation where we see US economy slowing down and US inflation staying sticky. And historically, in such conditions, gold really tends to do well because when growth takes a setback, obviously investors rush to the relative safety of gold compared to other assets like equities, and also because of its store of value qualities, gold is also a preferred asset class when it comes to inflation. So this will be one important driver for gold in 2024. I think the other thing that will drive gold prices, or in fact Fed policy, is the debt levels in the United States have really been ballooning. If you see, the graph, the chart on the left, I mean, it's at $33 trillion, and look at the way it has gone up, post the pandemic, especially in 22 and 23. The government's debt to GDP ratio in the US now stands at 123%. So these are big numbers, and a number of reasons for that. Of course, there was a lot of pandemic era spending that they did, but also the high interest rates, that have come into the picture since mid 22. That has really, escalated this, and the burden of higher interest rates is starting to show up on US government debt, and making the situation unsustainable. We are having a lot of credit rating agencies that have actually reduced the credit rating of United States government from, or United States economy from, stable to negative. So that is another development that should weigh on what the Fed does with its policy next. So if you move to the next slide, this is the background which I wanted to set to tell you, what we're expecting in terms of what the US Fed will do with its monetary policy in 2024. So, of course, if we see, a growth setback, however mild or, severe it might be, at some point, the Fed will have to kind of, respond, accommodate or ease policy and, try and help US growth. So in that sense, when that happens, we can expect, US yields and US dollar to kind of move lower. And because gold has an inverse relationship with these two, that is when, we can really expect gold to really move up. In 2024, markets are currently pricing in 125 basis points of rate cuts by the Fed, and the first rate cut is expected as soon as March. So, of course, that is debatable, and time will tell when that rate cut will come. But definitely, 2024 will bring with it the next phase of the US monetary policy, and that should be supportive of gold prices. And I think lastly, one other thing that has been like a soft support for gold prices in 23 and, is expected to be in 24 is that central banks, are really bullish on gold. They have been buying a lot of gold, and a number of reasons for that, their intention to diversify away from the dollar, or their intention to hedge against inflation, or just the geopolitical risks that may be leading to this trend. But if this happens, if this trend continues, we can definitely expect that to be a soft support for gold prices. So quickly to summarize, I think 2024, the prospects for gold are looking good. As from the returns perspective, as and when the next phase of the US monetary policy kicks in, and also from a portfolio diversification perspective, because, we are, expecting some vulnerability in risk assets, globally. And as such, gold can be a good portfolio diversifier as it has in 22, 23, and even historically. So with that, I think I'll pass it on to George. Over to you, George.
Thanks, Ghazal. So I'll give an reading of how we read the equity markets and how the next year is likely to pan out. In terms of the equity block, where we feel based on your risk appetite, you can have about 80% allocation to equity, and within that equity block, you can split between multiple styles and funds based on how comfortable you are. Our recommendation is the base portfolio should be a value fund where risk is given higher importance, because value tries to buy stocks at a discount to its intrinsic value, and by its inherent nature, there is a better risk protection mechanism there, and you can build your higher allocations to the growth style and the small cap funds. Next slide, please. Yeah. So one of the major driver on how the markets are driven is how the corporate earnings pan out. So what we have seen over the last few years was post-COVID, we saw reasonably high inflation, but we also saw a quick demand revival post temporary post a small bump during the COVID period, and therefore so in the initial years we saw demand kind of picking up, but companies were also facing rampant input cost inflation, and therefore, even though the demand was on a higher side, the profitability was suppressed in the initial couple of years post-COVID. But over the last year, we have seen those input costs kind of moderating, and then companies were required to take much lower price hikes to protect their margins, and therefore we saw that growth in the profitability moving upward. So going forward, our sense is as the inflation might remain benign or much lower than what we saw in the last couple of years, we could see the demand side picking up, primarily because customers have kind of digested those higher prices, and meanwhile their incomes have also gone up. And therefore, going forward, our sense is it's time that demand would pick up, and because of volume growth, we would see earnings quite reasonable in the next year. Next slide, please. So this is how the recent earnings season kind of panned out. So based on what the analyst saw in the result season, this is a change in estimates for fiscal year 24 and 25. Fiscal year 24 is the current year till March 2024, and 25 is the upcoming year. So broadly, earnings were supportive across sectors, and that is indicative in terms of the change in earnings estimates for Nifty, which is somewhere in the middle, where we have seen a marginally positive upgrades in FY24 and 25 earnings for the overall broader indices. But of course, within sectors, there were some bit of divergence, but those divergence were not very stark. So if you look at the strong points, auto continues to be fairly favorable. The volume has started picking up, and even the margins are on an improving trajectory. So coming to healthcare, one of the major markets for pharma companies, the US market is showing some consolidation in terms of the number of suppliers, and therefore there is a reasonable pricing stability in the US market, and that's translating to recent good visibility on their earnings profile. Coming to the negative side, FMCG, in the rural side, staples are seeing some moderation in terms of their volume growth. But our sense is, as we are nearing elections and the better farm prices should support the rural demand sooner than later. IT continues to be one sector where there are near-term demand challenges, but incremental data points from the US suggest possibility of a soft landing, and therefore all the corporates or the clients who have been waiting to accelerate their IT spending could see their budgets moving up over the next year. So even we are seeing some impact of that in terms of early sentiments for the sector and movements of the last few days. Banks, obviously, we were expecting some pressure on their spreads this year. Last year was the year when they could reprice their loans, and that that resulted in an expansion in their spreads or the margins they make. And as expected in the subsequent year, even the deposits have started repricing to the higher prevailing interest rates, and that has set in terms of a slightly muted earnings in the current quarter, but that was factored in the stock prices, and even after factoring those pressures on names for long-term investors like us, it is offering decent upside potential. Coming to the next slide in terms of how the earnings panned out over the last few years. So I would draw your attention to those two red lines on the bottom. So from FY15 till FY20, we saw very negligible earnings growth. And in all those years, analysts started with certain estimate, and the actual EPS number or the earnings number which transpired for the Sensex or the broader markets came much lower than what analysts estimated at the initial phase. And as a result, the earnings growth was very negligible. But being an environment with easy money flow and some part of the world even with negative interest rates, we saw reasonably strong flows into the market, and that resulted in markets hitting more highs and valuation multiples expanding despite muted earnings. But what we have been seeing in the last three years is a complete reversal, where analysts are expecting earnings to come at a certain level, and the actual earnings are coming out much higher than what they expect. And even the rate of earnings growth has picked up quite massively. This is an indication of a classic earnings upcycle, which could continue for a few more years, and that is fairly supportive from the broader market perspective. So coming to the next slide, So where we have given an indication on where the valuation lies. So from a broader market perspective, the valuation multiples are slightly above the long-term average. There are, of course, individual stocks and stories where there is good growth potential. But from a broader market perspective, the valuations are slightly above their long-term average, and therefore the stock returns in the next few years would be driven by earnings growth. And since we are quite bullish on that earnings trajectory, our sense is our markets should give reasonable return in line with what we saw in the historic times. So I would come to some of the drivers which could keep this momentum going. And one of the major drivers is real estate, where after almost a decade of flattish sales, we saw that real estate sales kind of picking up meaningfully. And the importance of real estate sector is it's a number 2 employer next to agriculture. And when real estate picks up, you would see a lot of remittances happening to the rural side of the country from workers who are employed in this real estate sector. And it could also have some ripple effect on other sectors like consumer durables and two-wheelers and all of that. So overall, it's a fairly supportive environment. And the sales are doing good, and that would have positive spillover to other sectors. And the second thing which makes us optimistic that the cycle could continue is the affordability. Unlike the early, about a decade back when, or post 2009, when we saw massive rally in real estate, the builders were hiking prices to a massive extent, and that impacted the affordability to a large extent. That has thankfully not happened in this cycle, and builders are cognizant of maintaining that affordability. So affordability remains reasonably good despite the interest rate hikes which we have seen over the last few years. And therefore, there is a very good possibility that this cycle could continue for the next few years. And the other major driver for the economy is in terms of the employment generation potential, be it the IT sector or the manufacturing sector. This chart, it shows up the scale in which the global capability centers are hiring. So these are development centers for global institutions like global banks like JP Morgan or Bank of America, or even enterprises which are based out of foreign geographies, where they're seeing India as a good source of tech talent and a reasonably educated engineering pool. And therefore, we are seeing good hiring plans, and hirings have picked up significantly compared to previous years. And this is not just in the IT sector, these are across sectors. We are seeing multiple themes like electronic manufacturing picking up, and there is a good possibility that even a lot of other manufacturing services where human talent is involved, where engineering skills are involved, India could back orders on those fronts. So summarizing what we are seeing for the overall market trend in the next slide. So valuations are slightly above long-term mean, but if you look at individual names, there are still opportunities. So for instance, in the value fund, we added almost 3 stocks in the last 2-3 months when markets remained at all-time highs, primarily because those individual stocks had undergone a significant correction. And considering their earnings potentially in the next few years, those were available at reasonable valuations. As far as foreign flows are concerned, in the current interest rate regime, there could be pressure on FPI flows until we see that the FPIs are quite convinced that the interest rates could take a downward trajectory at some point. But nevertheless, domestic flows are fairly strong, and given the under-allocation of the Indian population or the earning Indian class, we could see that domestic flows being fairly supportive, and that could provide downside protection to markets. So economic activity remains quite resilient. The government capex has been strong for quite some time now, though we might see some moderation going into elections. But our sense is from a longer term or a medium term perspective, capex should lead the recovery. And there is some possibility that even the private capex could pick up, though we are not factoring that in our numbers. And if that were to happen, we would see a much stronger earnings trajectory going forward. So from an earnings perspective, so far we have seen those the profitability picking up in the last few quarters, but going forward, even volume growth is likely to pick up, and that would ensure reasonable growth in earnings. So coming to potential risk, though most of these risks are seeing some signs of moderation, but something which could emanate over the next year is one, there are a lot of geopolitical conflicts which are happening, and that could keep the crude prices at elevated levels. And the other major risk is if the interest rates remain high globally for a longer period of time, we could see moderation in terms of global growth, and that could have some impact on the global demand, and that will have some spillover in India as well. But India being primarily driven by a domestic economy would see much lower impact compared to other parts of the globe. And over the last few years, what we have seen is the larger companies have gained share. So the economic uptick has not percolated to a large extent to the small and medium enterprises. But that is a huge employment generator from an Indian economic perspective, and that was a challenge in the last few quarters. But going forward, there is hope that as inflation moderates, the small and medium enterprises should be better equipped to handle the risk and take things forward. But having said all these points, Indian corporates over multiple periods have proven to weather all these troubles and risks, and they have come out fairly strong. We have seen that in multiple sectors. And our take is, if you have a basket of well-researched companies, those companies should be good to overcome all these challenges. So I'll quickly run through the two funds which I manage, and then I'll pass it on to Chirag. So coming to Quantum Long-Term Equity Value Fund, which you can consider for your value allocation, and this is managed in a value style and managed with a long-term approach, which is also seen in our low portfolio turnover rates ratios. So we buy companies at a discount to intrinsic value, and that provides some support in terms of downside protection and better recovery during times of market correction. So coming to the next slide. So one of the critical elements of any fund in quantum is the predictability of the process. So here, what we have depicted is how the fund has performed versus our estimates or expectations on a 2-year prior basis. So if we take every stock has certain buy and sell limits. The sell limits are very similar to the target price, which you typically hear, where we expect that stock to reach that level on a 2-year forward basis. And when I aggregate those target prices of individual companies and multiply those with the weights of those individual companies, we come up with a target price for the overall portfolio or a target NAV. So the orange line which you see is our estimate based on what we expected those stocks can reach in terms of their fair value on a 2-year prior basis. And that blue line is how the actual number has panned out. So if you see that orange line has very closely tracked the blue line, which is kind of a testimony to how strong the process is, and that has been true since its inception for almost 15 years, barring few points where there are certain dislocations which are difficult to predict. For instance, the COVID crash would be an event which is impossible to predict on a 2-year prior basis. And those points, you might see some deviation with the actual estimated NAV, and that was the same case during the global financial crisis. But barring that, it has more or less tracked our expectations. So going forward, if you look at those green patch, so actually those circles are a little dislocated, where we saw a consistent earnings growth over 4 or 5 years, starting from 2011. And that was a period when there was reasonable earnings growth, and we were able to ride those earnings growth in terms of in our portfolio companies as well. And those kind of a scenario is what is likely to pan out in the next few years, unless there is a global event, which is anybody's guess. So coming to the next slide. So coming to the characteristics of quantum long-term equity value fund, across time periods, if you observe, the fund has adhered to its value characteristics, which is depicted by a higher dividend yield compared to index. The valuation ratios or PE ratios would be at a discount to the index, which is at 14.6, which is almost 20% lower than the index valuation. While earnings growth could be marginally lower, but that valuation multiple adjusted for the underlying earnings growth is at a reasonable discount to what the index has kind of depicted. So coming to the next slide. So we have a fairly similar portfolio under the ELSS category as Quantum ELSS Tax Saver Fund, where the characteristics are a replica of what we saw in the Quantum Long-Term Equity Value Fund. And this is one of the few funds in the ELSS category where there is a value tilt, and this could be a good complement in terms of your ELSS allocation if you want to distribute it between multiple styles. So with this, I'll take a pause and I'll pass on to Chirag for the other funds.
Thank you, George. Coming to a second allocation in the equity bucket, this Quantum India ESG Equity Fund. So overall, if you see, this fund gives you a great way to invest into Indian equity markets, banking on sustainable companies that take care of stakeholders. And we have been seeing time and again over years that this kind of approach or this kind of companies really lead to the compounding of returns that you usually want from your investments. So overall, I think it's a great way to invest into Indian equities, banking on sustainable companies that are good in terms of its behavior with its stakeholders. And overall, we have seen that in the real world, where we have a track record of nearly 4.5 years, it's performed well, banking on sustainable companies and yet delivering returns. So the premise that, you have to give up returns to do good and invest in good companies that are sustainable, it's not really true, because good companies that we have in the portfolio have delivered well and generated good returns for investors. What is the biggest difference that we think we bring to the table in this is, we think that ESG research or sustainable investment research or responsible investment research is not desk research. Today, companies have been forced by the regulator to give a lot of data on how they manage the environment, how they manage the social factors, how they manage its governance. Given that a lot of data has to be given out, there is a lot of incentive for companies to greenwash, because if they give out bad data, probably no investor will touch those companies. And therefore, you need to screen these companies on a realistic basis to ensure what they're saying and doing is the same thing or not. And therefore, when you just do based on disclosures made by the company, you are not evaluating them well. You need to do a lot of ground research, and that's what we do at Quantum. We have an independent research team just of ESG analysts, and they kind of go on the ground, meet companies, look at their plants, factories, do a lot of channel checks to identify if there are any red flags. And if there are any red flags, we don't invest into those companies. And I think that has been a differentiator into our ESG as opposed to any other ESG. And that is helping us to outperform markets in our 4.5-year journey that we have had with the ESG fund. So overall, we think that this edge that we have built, the proprietary framework that we have, is leading and making the difference in our ESG fund as opposed to what we see in the indexes overall. Also, if you see, given that it is more a growth style investing, it may appear slightly elevated when it comes to the trailing PE, which if you see stands at 30 times versus 22 times for the Sensex. But if you see the earnings growth here is much higher as compared to Sensex. And overall, on a forward PEG ratio basis, appears slightly expensive. But we have seen that quality comes at a price and quality delivers over the long run. And that is what we have seen in our track record as well. So usually it has stayed expensive, but it continues to generate returns for investors overall. Coming to our latest offering, which is the Quantum Small Cap Fund. If you see, there are various challenges when it comes to managing the small cap fund. And those challenges generally emanate from the size of the fund or the AUM that the fund has, and which leads to deviations from what was a historical portfolio to what is the current portfolio. And therefore, we see a lot of suboptimal sizes. We see challenges with liquidity. We see challenges with being large owners of those companies. And here with the Quantum Small Cap Fund, we are here to address all those challenges, give you a true to label fund that also prioritizes liquidity and market cap holdings in those companies. We build a high conviction portfolio. We don't want to be closet indexes and have a very diversified offering. When the tide is up, when everything is doing well, probably a diversified portfolio will do well. When things change, because markets go sideways, markets correct, that is when the high conviction, highly researched companies, a strong portfolio will deliver better, and the closet indexes will find it difficult to outperform into those markets. So we don't want to be closet indexes. We want to be a high conviction portfolio with not suboptimal sizes, but adequate allocation to each and every stock. Because if we have research teams, if we do our own research, we need to showcase in our conviction into those stocks. And therefore, we will buy minimum 2% at cost on any company that we hold in the portfolio. And therefore, at 2%, it translates into a maximum of 50 stocks. Here you 60 stocks in the range that we have shown, because there could be companies that we are entering, building a position or exiting out of it, and therefore slightly larger range of 25 to 60 stocks. But we want to have an adequate position in each portfolio, which we think is about at least 2% into each stock. And we are very agile, given that we will try to be judicious about building our allocation, and we have a track record of constructing portfolios since 2006, and we will use those learnings to build a portfolio in the small cap world for you. So taking into or balancing out risk and reward, risk of liquidity, risk of being high owners into companies, at the same time optimizing the opportunities that the small cap world offers. Build a stock specific portfolio, a high conviction portfolio, and deliver that long-term risk adjusted returns for you. So as I said, liquidity and market cap are important considerations when we are building the portfolio. We have strong research capabilities to navigate the large small cap universe that exists. There are about 800, 900 stocks from which we need to build a portfolio of 50, 60 stocks, which is what we are doing. We emphasize on governance and management quality, which is very, very critical to back good quality managements. Though no matter you may have identified the right sector, right place to be, but if the governance or management quality is not good, probably you may not end up making money as a minority shareholder. So what approach we follow, though we are known as value investors, but we do know different styles. Like in the ESG, it's a growth style. Here, it's a style which is growth at reasonable price. We want to back growth companies. We will chase growth, but we will be mindful of the valuations that we pay for those businesses. And therefore, we think the appropriate way to approach the small cap world is growth at reasonable price. And we will have a long-term approach to capitalize on the compounding that the small cap world offers, because as India grows, these smaller companies will grow significantly. They will be at an advantage of being not only supply chains to the world, but supply chains to the companies that are setting up businesses in India. So we will back those companies and build a portfolio that delivers good returns over the long run for the investors. That's about the small cap, but over history, like managing the quantum equity fund of funds, We think that there are various 4 Ps largely that lead to a good fund manager. The philosophy, the process, the performance, all are very critical drivers when it comes to building or identifying a good fund. And we think that usually investors end up chasing performance, not looking at the risk. And risk are generally on account of the philosophy or the process or the people that they are managing the fund for you. So you need to identify what are the systems and processes that they have that will define is the fund manager good or bad. Because at so many occasions we have seen whenever the fund manager changes, there's a big churn in the portfolio, which is not really conducive to what we have seen and invested. And therefore you end up seeing something, being convinced about something, and you end up getting something else. So you need to see whether there are systems and processes in place for the fund house to manage your investments or not. And they need not be just a one cycle performer. It shouldn't be that they just do well on the bull cycle or the bear cycle. They should be able to perform across the cycle, across the bear and bull phases. And that's the fund that you need to back up and include in your portfolio. What is the asset management style? Like, what is the portfolio turnover? Is there too much churn? When there is too much churn, you're banking that each time they churn, they end up getting the right stocks. They have the right calls each and every time. In a bull market, probably they may get all calls right. But when tide changes, they may find it difficult each time to get the right stocks in their portfolio who will be winners over the next 3-6 months of their holding, which we don't think is a very conducive, because predicting the 3-6 month behavior sometimes is very difficult. In a one-way street, it's easier because everything is moving up along. But when the markets correct significantly, that is the time when you're churning every 3-6 months, you will find it very, very difficult to kind of get the winners each time. What is the concentration into these funds? What are the top 5 holdings, top 10 holdings? How concentrated they are? It should be balanced in terms of diversification and concentration. What is the expense ratio? What is the portfolio PE, etc. Portfolio characteristics, as we call it, needs to be taken into account. And whether the returns are backed by not taking too much risk is also need to be adhered. Like, what is the standard deviation? What are the information ratio? What is the up-down capture? Now, what is the downside risk? When markets fall, how much the fund falls is also need to be taken into account before you identify and back that fund. And of course, the performance. We would like to see investors look at predictability of performance. But again, it's very difficult to identify, like what George showcased is a predictable performance. Each time we can repeat that because what we as a process forecast as our value, we have gained those values over a period of time. And that tells you that, the process is working well for us. So you look at track record and just not look at the trailing returns, look at rolling returns, because that will help you identify the right funds. Because more consistent the rolling returns are, more better that fund performance in terms of consistency. And therefore, consistent funds are what you need to back into your portfolio. So overall, again, reiterating our point that you need to have an asset allocation. It's very, very simple. It's no rocket science. Just think over it, what suits you well. And we have a tool on our website that helps you do that very, very easily. You put in your planned investments, or your portfolio value. You look at your monthly expenses and how many months of expenses you need as emergency corpus, and you can tweak your equity and gold allocations, and it'll give you a portfolio and various analysis around it in terms of what your typical allocation should be and what you ending up having. Those kind of comparisons are easier and gives you a perspective into how you can shape your portfolio. So do visit our website and look at this tool, which is very, very helpful in terms of building your own asset allocation. So with that, I come to the end of our presentation, and we will be more than happy to take any questions that you may have. With that, over to you, Neeraj, for the question and answers.
Thank you, panel, for the insightful presentation. We'll request all our investors to post their questions in the chat box. In the meantime, we have already received few questions via email before the webinar. So we'll start with that first. Chirag, the first question to you. How do you assess the potential impact of global economic trends on mutual funds in 2024? And what strategies are you employing to navigate potential market challenges?
Sure. So we have time and again into all our investments, we need to take into account what is the external scenario, what is the India scenario overall, because companies don't operate in a vacuum. There is global policies, there is global scenario, there is Indian policies, Indian scenario. We need to take into account everything, the sector in which the companies operate, the kind of the company's product lines, etc. We have to take all into account before we kind of make our judgment on the company. So there is a lot more that goes into our analysis when we choose or we research a company in terms of the influence that the global and domestic scenarios or will have on those companies. So currently what we see in terms of the war, so we will see that if the war escalates, what is the impact on inflation, what is the impact on crude oil, what is the impact on the export demand, etc., will all be taken into account before we kind of make a judgment on that company. And in each company that we analyze, we'll have different scenarios and therefore a sensitivity in terms of if this scenario plays out, what will be the impact on the earnings of those companies, the profits of those companies, and therefore our target price of those companies. So we take everything into account before we kind of analyze those companies, and we will ensure that we kind of leave no stone unturned, and therefore all the moving factors, be it global or domestic, they are taken into account when we research those companies. There could be possibility that we may miss certain points, but we will keep reviewing, and we even if we are reviewing a pure company or a related company or any other company in other sectors, there could be information that we gather that may impact other companies in the portfolio, and therefore all goes into account when we do that. Also, what we do as a part of our research, for every sector, we also look at global companies. So how global companies have moved through the curve in terms of their trajectories that help us know that what is the possible trajectories that these Indian companies will go through, and therefore helps us analyze those companies more critically, as opposed to not just looking at the current scenario. So we do a lot of research, we do a lot of channel checks, we do a lot of scenario analysis and sensitivity analysis to help us decide what will happen with those companies if things change. So that is how we kind of forecast the impact of all these factors into our company analysis.
Thanks, Chirag. George, next question to you. It's on long-term equity value fund. How quantum value fund manages risk and lowers them for unit holders? If risk is measured by standard deviation, then quantum value fund standard deviation is almost same as Nifty index fund and higher than few of other mutual funds. So I would appreciate a good perspective on why I am taking lower risk and getting better long-term risk-adjusted return by staying invested in quantum value fund compared to index or other mutual funds.
Yeah, sure. So I'll first give the stats and then go to the explanation part. So if I compare it, quantum long-term equity value fund with its benchmark, which is BSE 500 total return index, the standard, of course, you're right that standard deviation is a good measure of how the risk is managed, but we don't directly target to have a certain standard deviation when we select stocks, but that's just an outcome of how our process is designed. So when I look at the standard deviation of quantum long-term equity value fund since inception, that is about 19.6% compared to 22.7% of its index, which is BSE 500. That's about at 3 percentage points lower than index. So if I look at a more near-term number, over the last 3 years, quantum long-term value funds standard deviation was 12.01% versus 13.77% for the index, which is BSE 500. So even if I want to compare it with Nifty, since Nifty is more large cap or is large cap oriented, and therefore it has it has a lower standard deviation compared to BSE 500. Even with that, we are about 160 basis points lower or since inception and 140 bips over the last 3 years. So if you were to measure the risk-adjusted performance, a good way to measure is in terms of Jensen's alpha. So that kind of adjust the return you get with respect to the kind of risk you are undertaking. That risk metrics, so if I want to explain that in simple terms, so let's say if the market moves up by 10 percentage points, if QLTVF moves up by 8 percentage points, that seems, that correlation is about 0.8 times. So when the market moves up, similarly, when it falls down by 10%, it should not fall by 10%. It should fall, let's say, by 80%, which is 0.8. Should be the correlation. So for QLTVF, since inception and even for the last 3 years, the beta or the correlation with QLTVF and its benchmark is about 0.83 times. So 0.83, which is less than 1, which means it's not as volatile as the broader markets. So with that, if we adjust our alpha or the excess returns which we have obtained compared to the risk-free rate with that beta number, that's how this Jensen's alpha is computed. We can share the detailed calculation if you're interested to see. So that comes at around 1.67%, or 167 bips since inception, and over last 3 years it is about 93 bips, 0.93. This is despite a small and mid cap having given a very stellar performance over the last few years, and we with the kind of filters and entry criteria we have, we generally tend to be large cap biased. And if we compare it with Nifty, that Jensen's alpha, which is a measure of the outperformance adjusted for the risk which the fund takes, it is about 2 percentage points since inception and 3.14% in the last 3 years. But of course, from a metrics perspective, it looks reasonably okay. But the broader point we need to remember is, let's say, for the last many years, like I showed the chart from FI 14, 15, 16 for a few years, there was a period of easy money flow, and some parts of the world were even having negative interest rates. So even despite muted earnings growth, there were money flowing into the markets, and that resulted in PE bands expanding despite the muted earnings growth. And that's not conducive for a style like in the way we manage quantum long-term equity value fund. And therefore, those risk matrices or probably what the process would have had a much better risk protection compared to index, that is lowered because of this reason. Only when those risk fact is factored and when the return is commensurate with the risk taken, that is when all these matrices would stand out in a better way. So I'll take a pause there. Yeah. I hope I have answered the question.
Yeah, Neeraj, just to add further to what George said, I think volatility standard deviation is one form of risk measurement, but it's just the up and down movement of the market, and markets will keep moving up and down. But it is broadly the risk of capital loss, risk of investing in bad companies that would generally not come with Quantum's processes that we have built. So we only invest in high quality governance companies, no matter if the company does not have good governance, and even if they are a large part of the indexes, we would not invest into those companies to an extent. And therefore that risk of capital loss to a high extent is avoided because of the processes that we have in place to select good companies. So broadly, I think investors should look at from a quality, from a governance standpoint, and risk of identifying good companies through a good, strong research is what we do at Quantum.
Thanks, George and Chirag. Pankaj, next question to you. During COVID times, in particularly the first webinar in April, May 2020, Quantum Mutual Fund dialogue was totally different and negative when even Mr. Ajit Dayal was negative. He was also questioning why no cash doll out wasn't made while Western world was doing it, etc. Now in 3 years later, we see here the opposite view, like extreme optimism, while 3 years ago it was totally pessimism. Why these extremes?
Let's understand why we were asking for some support, income support or something, especially for the poor income groups during that time. So the whole idea was that people were working from home, and who can work from home that time, they accumulated saving, they boosted consumption, and that we are still seeing the impact of that kind of consumption. But the other part of the economy, which kind of dependent on going to work and more involved in, say, people in construction industry or many of the other sectors who are normal vendors who were unorganized sector people were not able to work from home, their income losses were not compensated. And that's the impact of same we are impact of that thing we are still witnessing in the K-shaped recovery we witnessed over the last 2-3 years. Now, if we compare, because there has been a lot of comparison, and we often hear it, people comparing with the Western world, where they kind of provided too much, but their problem is very different from our problem. They have a very tight labor market, and like in US, US Fed is trying to kill jobs in a way. They want employment numbers to slow down. They don't want too much of employment. Where on the other hand, in India, we have a very different problem, where one sector of the economy is doing pretty well, which is more tracked by the stock market guys like us, kind of benefit out of that because the organized sector, a small pool of companies, doing very well. But the other part of the economy is still struggling, and that we can see in the employment numbers still. So where overall employment is still very low, that has not recovered. And still we see that in consumption patterns as well, where you see more SUVs getting sold, but smaller car demand is still very low. We are just seeing some pickup in now two-wheeler sales, but earlier that also suffered. We have not seen that kind of participation. High-end luxury homes, you see very high demand, but on the other hand, small ticket affordable housing, that is still struggling. So all those differences were there, and I think we took time to for these things to bottom out. Maybe now things are bottoming out. We are seeing that there is some switch in commentary, especially you can see that in companies in the FMCG sectors, when they started talking about demand revival in the rural economy and all. So things have started to bottom out. Maybe over the next 2-3 years, we'll see some improvement in that segment. But given what we were saying that time, the thesis remained the same. That segment of the economy, they didn't get that support of what was desired, and that's the reason why they are still struggling three years after the COVID. So yes, I think I have answered this question. Chirag, if you have anything to add in this.
Yeah, sure. I think this chart tells you, if you see the FY21, because of lockdowns, there was so much uncertainty, and businesses were shut. There was no activity happening, and therefore there was a cause for pessimism at that time. And that is why we were so pessimistic about the prospects, because we didn't have a clue of how things will pan out, because this is something that was never witnessed in Indian markets or even global markets. So that is why we were pessimistic. And if things have revived, you would have seen our commentary change, because we saw things picking up on the ground, and there is a lot of activity happening, as opposed to the period from 2014 to 2017-18. There was nothing much happening on the ground, and there was a cause for optimism, and that is why we are optimistic. So currently we are seeing green shoots, not only green shoots, but a recovery in the economy. At least the urban part is moving very well. Government capex is helping. Real estate is helping. So all that levers that we see make us more optimistic, and we think that there is still legs to this recovery, and that is why we are more positive. And we have seen that in the earnings growth, revenue growth, earnings growth of companies, which is again reflected in the stock market. So if you see the lines on FY22, FY23, FY24, you see the earnings growth. Whereas if you see from FY14 till FY17-18, it's been a flattish line that ends up each year, starting with an optimism and ending a much lower into each period. But now if you see, each time we are seeing upgrades, right? We start at a lower level, and if you are ending at a higher level, which means that earnings, people are surprised by the earnings that the companies are delivering. And that is the case for optimism, because things are really moving on the ground. If there is a pessimism when we do our checks with companies on the ground, and if we see things not moving, that is why we'll come again and tell you that, you know, things are not moving. It's time to take bets off. But currently we are still seeing that momentum continue. And that is why we are positive this time around.
Thanks, Pankaj and Chirag. Ghazal, next question to you. What is driving gold price in the recent past?
Sure. So we see the recent uptick in prices started somewhat in the first week of October, when the conflict between Israel and Hamas broke out, and that kind of led to risk aversion in global markets, and investors chose the relative safety of gold, and we saw prices really run up. Now some of that geopolitical risk premium in gold has sort of unwound, because the situation there has remained contained. It has not turned into a wider conflict. So that's one reason. And also, we have seen this renewed expectations of softer Fed policy in 2024 that have come in, that have resulted in a sharp correction in 10-year treasury yields, and even the US dollar, pushing up gold prices. So we also are cautiously optimistic that rates in the US have peaked, which makes a good investment case for gold if we take a more medium-term view. But in the short term, I think markets have priced in very optimistically some rate cuts coming in 24, and the timing of those rate cuts, which could be vulnerable to some reversal in the very near term, especially if the Fed comes back with some hawkish commentary on its December 13th meeting. So I think that will be a good opportunity, the volatility around that period, or in the next couple of weeks, that can be a good opportunity for investors to buy gold.
Thank you, Ghazal. Chirag, next question to you. Out of equity investment, what should be the distribution between large cap, mid cap, and small cap?
So something that's more conservative, that is what large cap is, should build the base of your equity allocation, then followed by mid and small cap allocations. So I think the bulk of your equity allocation, about 40-50%, should be that large cap bucket. Large cap means not just large cap, because large cap funds are constricted to invest into large cap stocks for up to 80% of their portfolio. So probably something that is more flexible, like a flexi cap, or a value style that we have, which is more operated like a flexi cap, could be a good base that you can build into, and followed by something like a growth investing. So once you have built the base, you can have some growth allocation on top of it, and then at the very top, you should have mid and small caps. So small cap should not be more than 10-15% of their portfolio. People are glued because last 2 years have been great return generators for small caps. Probably, I think asset allocation is again important, and allocation within each bucket should be as per the risk and opportunity. So overall opportunity is great in small cap, but at the same time, risk of these businesses be new, management's be new, untried and untested to an extent, and hence about 10-15% allocation to small cap is what we would think is optimal from a allocation perspective. So base about 40-50% should be more towards large capish kind of portfolios. And there we recommend the quantum long-term equity value fund or the quantum tax saving fund, followed by some growth on top of it, which should be like an ESG fund. And on top of it, small cap or mid caps should be about 15% of your portfolio. So mid cap could be another 10-15%, but small cap again 10-15% of your portfolio.
Thanks. Pankaj, next question to you. Fiscal deficit is continuously increasing. How do you think it will decrease in future? It is imaginary?
No, actually, if you look at the overall fiscal deficit, once it increased during COVID, it went above 9% of GDP in FY21, as I mentioned. And thereafter, it has been on a declining path to 6.9 and then 6.4% and now 5.9%. Now, if you look at the overall balance, there is a strong data which can kind of support that. So one, government is getting decent growth in their tax revenues. Usually what we have seen is that tax revenues are linked to nominal GDP growth. Over the last 2 years, we had a very high nominal GDP growth, mainly because of inflation. So one, we had coming out of COVID, there was a rebound, so a statistical adjustment in the growth number. And then there was a very high inflation, especially the WPI, which is kind of more of a producer inflation and had a higher kind of weightage in terms of getting reflected in the GDP growth. So nominal GDP, that's why looked very high, and that translated to higher tax revenue growth. But in this year, FY23-24, again, we are seeing a decent growth, a much stronger growth, I would say, especially in the direct tax collection than what government has budgeted. So most likely, we'll see government overshooting their tax revenue targets. So they'll get more money than what they had budgeted, and that gives them more spending power in this year. So given the election year, there could be some extra spending, but I think they are getting more revenue which can be utilized for that purpose without breaching the fiscal deficit. On the other side, if you see, there has been a spending cut on many areas, especially in the revenue spending. So they are spending more on the capital side, where building railways and road and all this infra spending, whereas many of the spending on the revenue side in the revenue account, and on that front they have been more tight in terms of spending. They're not spending that much. So I think that strategy will probably continue, and that gives government enough headroom to reduce fiscal deficit further. So it doesn't look imaginary. I think this trend, what we have seen till now, that suggests that even in next 2-3 years, probably they'll continue with the fiscal consolidation plan, and they can do it easy.
Thanks, Pankaj. Ghazal, next question to you. Sometimes silver beats gold on returns. What is your take on silver?
Sure. So silver has this dual, set of price drivers, I would say. The same drivers that drive precious metals like gold, and also drivers that drive, industrial commodities or risk assets, if I may say that. So in that sense, someone with knowledge of, silver markets can definitely take a tactical call when it comes to silver allocation. And from a returns perspective, yes, that could work out in your favor. But historically, we have seen silver prices, tend to be much more volatile than gold. So that's one thing I would look out for. And secondly, I think from a portfolio perspective, if you're looking at both of these asset classes, silver and gold, gold, tends to be the better choice. A couple of reasons. Because of its, negative correlation to equities or risk assets. It really helps limit downside and is a good complement to an equity portfolio. Whereas with silver, because the drivers there, are common with equities, you could see some large price movements, which could be in line with equities, and hence, not really giving you that, diversification benefit. So yes, from a portfolio perspective and from a strategic asset allocation perspective, definitely gold is, a better choice.
Thanks, Will. Chirag, next question to you. Why quantum funds are not talked about much by the industry experts, and why quantum funds are not seen in top funds?
So I think I don't know which experts are not talking about quantum funds, but I don't know and the rationale behind that. But I think we would love for everyone to talk about quantum funds, and we'll try to reach out to as many as possible. But if you see, we have an emphasis on risk as well, at the same time trying to generate an adequate return for investors. And probably that could be a reason, because you see what we have learned when we manage the quantum equity fund of funds is not many funds remain at the top when they are at the top. So we have seen that there is a good rotation that happens at the top, and investors fall in trap by chasing the funds at the top and therefore investing in the wrong funds at the wrong time. Probably a better way to choose is consistent funds, and that is what we try to drive at Quantum. So if you see our funds performance in either of the phases of the market has been very, very consistent. And that is what we try to deliver to investors, a more predictable, more certain, consistent track record, as opposed to just trying to be at the top at some point of time in the market cycle. So probably that could be a reason why we're not at the top, but that's not completely true as well. We have been at the top at many occasions. And even in the ESG fund, if you see on our since inception basis, we are at the top when it comes to performance. Even the long term, we have been, or the tax saving fund, we have been in the top quartiles at many times. So it's not that if you look at a longer term track record of the value funds, value as a style was underperforming globally from 17 to 19, and that is time we also have seen underperformance. The value as a style was not doing well. But post that, if you see, we have done reasonably well in terms of performance. So we think that it's how investors look at performance, and I will urge investors to look at more consistency in the performance that we deliver, as opposed to just the ranking, because rankings are transitory in nature, and to look at more consistent over a cycle performance, as opposed to just one phase of the performance.
Yeah, Chirag, in continuation to this, there are a couple of more questions. Like, as expert says, one should not invest all money in one AMC. What's your take on it? And secondly, why you removed quantum equity fund of funds triangle strategy, as you used to say that it's for diversification?
No, so that's true that one should diversify wherever possible, so that at the same time, over diversification also hurts returns. So probably, we're not saying that give all money to quantum, but these are the styles that you can build a portfolio of yourself. You could split it into so value, if you feel like any other value fund or any other flexi cap fund. Probably you could build the base with that, and then top it up with a fund which is more growth oriented, and a fund which is more. These are illustrations that we have given and cited quantum examples for that. But one is free to diversify into different fund houses. That is what we also recommended with the quantum equity fund of funds, because all that investments are flowing into other fund houses. But now, given that the taxation has changed for quantum equity fund of funds as opposed to the normal equity funds, despite that being a basket of equity funds, so until there is more clarity on taxation, probably one can wait for their further investments into quantum equity fund of funds. What are their original investments are there, have been grandfathered. So that is not a problem at all. But until we find an efficient solution, or the finance minister kind of changes in the behest of what is more logical reasoning and making equity fund of funds more tax efficient vehicle, because it is at the end of the day a basket of equity funds. Till then, we kind of thought that it was in the interest of investors to just remove it from the triangle, and one who is averse or not looking at taxation and still want to have an efficient allocation, they can still choose an equity fund of funds. But we didn't want to recommend because it's become an inefficient from a taxation perspective. And that is why we have removed it from the triangle. But investors who like the product, and I think it's a great product, it's working very well in the offshore markets. And hence, if someone wants to look at it, please do look at it. But we will include it back if the taxation changes and becomes equal in terms of taxation with other equity funds. We'll include it back. But until then, we chose it was wise to remove it from the top. There's no other issue with the equity fund of funds to remove it. It was just in the interest of investors to remove it.
Thanks, George. Next question to you. In the light of projection of EPS in 2024, shares of FMCG, IT, and banks would not be performing well in 2024. Is it right?
IT, probably at least in the current fiscal year, the earnings growth is likely to be muted. But the point is, historically, what we have seen is the share prices and the actual EPS growth does not really coincide. And as investors start seeing signs of things bottoming out, like we had some couple of news flows today with respect to, from the US economy side. And when things like that happen, investors tend to price in that before that actual number pans out. And therefore, it's very difficult to predict, whether those share performance would kind of mirror those EPS growth. But there is a very good chance that, those IT spends might come back next year. And in anticipation of that, stocks could perform this year as well. And the other additional point is IT as a sector offers a really good, reasonably good valuation comfort compared to broader markets. So even that is quite supportive for the IT sector. From a bank's standpoint, it was very well expected that their spreads would be under pressure this year, because typically in a rising interest rate scenario, when interest rates are reset to a higher level, in the first year, the loans gets repriced, and therefore that flows to a better earnings for bank. And in the subsequent period, you would see that even the deposits which the customers have placed with them, that would reprice to those higher interest rates. And therefore, the earnings could be slightly lower than what the kind of growth which we saw in the initial period when those interest rate hike happened. And as long-term investors, we price in all these numbers well ahead of time. And we were expecting this trajectory to play out. And despite that, there is reasonable values in many of the large banks. And have not participated in the market rally in the current year. And therefore, earnings are coming up reasonably okay. Plus, the stock price return has not been great. That's a good combination to have. And going forward, the credit cycle or those NPA cycle is likely to remain favorable. And that would also mean that banks will need lower provisions for their bad loans, and that means better profitability. From an FMCG perspective, there is some bit of slowdown in terms of the rural consumption. But being an election year and how things are likely to pan out, and the MSP hikes have been quite decent, and inflation is likely to be under control, at least in the medium term. And in this kind of an environment, it's very much likely that when the rural economy could see some uptick. But from a valuation perspective, most of the FMCG names are quite rich in valuation, and therefore we may not see very high returns of stock market return, because there could be a possibility that earnings could catch up and valuations come around the reasonable range over the medium term. So that's my take on these three sectors.
Thanks, George. Chirag, next question to you. People, philosophy, process. How does quantum differentiate on this two lower risk compared to other competing funds? Please answer with reference to better AMCs out there.
So I think those are the strong pillars that we think the quantum has been built. We think there are four pillars of the four P's, as we call it. First is the philosophy. What is the philosophy of the fund house? What is the who are the people behind it? What experience do they have? What are the processes that they have in place to manage investments? And what is the performance? And by performance, we mean predictability of performance, as George showed in that slide, which kind of tracks what we predict and what is the actual outcome on the market. That's more predictable, according to me, as opposed to just not knowing what the returns could be 2 years out. So you are then, taking a call in terms of. So as we manage the equity fund of fund, we meet a lot of fund managers out there, and we have seen that so many fund houses have seen changes in portfolio significantly when the fund manager changes. And that really tells you that it's more driven by the fund manager as opposed to be process-driven or team-driven approach. That is a really testament to what we see in other fund houses opposed to what we see in quantum. Quantum, there is a long continuity despite fund managers moving around, or the portfolio hasn't seen much changes over a period of time. Second is we have a very strong philosophy of ensuring there is a balance between risk and return. We don't take unnecessary additional risk when managing money. We try to ensure that the additional risk, for example, in the small cap, there is a risk of liquidity, there is a risk of market cap, but not many investors or fund managers not really look at those from those perspective, whereas we do. And at the same time, not taking those additional risks, we try to create a portfolio that delivers for the investors. So I think there is a lot of difference between what we see at Quantum versus what we see in other fund houses. To cite one more example is what we have seen in our experience at the equity fund of funds. They do have analysts, and usually even when we have seen that fund managers have moved in contradictory to what the analyst call was, that typically does not happen at Quantum. Quantum, there is a consensus-driven approach as opposed to just the fund managers taking the call. There's a lot of say that research analysts also have, because everyone, fund managers and the research analysts, will sit across the table, debate a stock, and decide on the buy and sell price of that stock. And the fund manager cannot go contradictory to that call that was driven by the consensus at that research meeting. So there is a strong process-linked approach that delivers, and therefore the continuity, the performance, the consistency comes from that process and team-based approach that we have at Quantum, as opposed to what we see in other fund houses. And we have seen and asked those fund managers, and they do take calls which is contradictory to what the analysts are, because the typical answer that we get is fund analyst does not understand the portfolio approach, but a call on a stock is a call on a stock, right? And therefore, if you think that the analyst is an expert on that sector, on that stock, then probably why to move in opposite direction to what the call of that analyst is. So those kind of things don't typically happen at Quantum. We kind of adhere to a team-based, consensus-driven approach, and that has worked well in terms of getting that predictable performance that we are talking about. So we are very long-term oriented, and we have a strong pedigree when it comes to global and Indian market investing. We are a firm which has been around since 1990 as a group, and therefore the experience that we have, the kind of the learnings that we have is all institutionalized and passed on throughout the entire team, as opposed to being just held at the top. So I think the approach that we have on the 4 Ps is the core differentiator that we think Quantum has an edge about as compared to the other fund houses.
Thanks, Chirag. There's a last couple of questions on small cap.
Sure.
So can you please help us understand how much research efforts monthly goes in picking up a new stock? How difficult it is to find small cap stocks given they have run up so much? there is a continuation. Like, what are your thoughts on quant-based investing? Can this give higher returns than traditional research-based investing?
So overall, firstly on small cap, yes, it is difficult because the universe is very large. You need to narrow down the universe, then deep dive into certain stocks and research a lot of stocks. So it's pretty difficult to identify stocks in that large universe that exists. And we are doing every bit, like our analysts are looking at and screening the universe and trying to identify the good companies within that universe. So there is a lot of effort. We have been researching on small caps since 2008-9, and we have been covering many companies in that. Given the valuations where they are, yes, there is a run up in certain sectors, but given the large universe that exists, there are pockets of opportunities which we are utilizing now and building the portfolio for you all. In next couple of days, you will see our portfolio out, which is the first set of portfolio, and we are building that gradually for you all. For our investors in the small cap fund. And by December, we would have deployed much of the capital into the small cap stocks. So you will see that it's more true to label. It has more small cap stocks. It's the first portfolio that will be released. And you will see the differentiator in terms of the number of names that we have in the small cap portfolio for you all to see and say that, this looks a differentiated portfolio overall. So yes, it is difficult, but we are doing our bit to ensure that we select the right companies for our investors. Coming to the quant-based investing overall, quant-based investing is trying to identify factors, indicators, and build a model around it. And what we've seen as model works till model works, right? Many times when things change, models stop working. So as quantum, we are more fundamental investors, and we understand that fundamental investing, we don't really, when it comes to choosing stocks, etc., and screening them, we do screen stocks based on certain parameters, but that's not, we do deep dive into each and every stock that we narrow down to. So only to that extent we use quant to an extent, but otherwise, for multi-asset, etc., we do use a lot of quant, but there is a lot of qualitative analysis that goes on top of that quant to kind of allocate or choose funds for the equity fund of funds that we do. But from a quant-based perspective, I think fundamental investing has more predictability, more stronger hold on those companies. And therefore, I think that is a better way to go about it as opposed to quant-based investing. George, you want to add anything on quant-based investing? Otherwise,
I think you have answered it pretty well.
Thanks, George.
So, Chirag, last question for the day. Will small cap continue rallying in 2024 with the intensity it showed in 2023?
So last 2 years have been a broad-based rally in the small cap world that we've seen. Going forward, it could become more selective, more a stock pickers market as opposed to one-way rally into because earnings momentum that we have seen, probably it will continue in certain sectors and will slow down in certain sectors. Much of the earnings optimism is priced in certain sectors. For example, capital goods as a sector, we have seen a lot of being already priced in. So certain sectors are still attractive. For example, financials look still attractive. So I think it, as opposed to being a broad-based market, it will narrow down into a more selective market going forward. But I think small cap, given the large universe that exists, there is a lot of opportunity overall, and that should continue to do well over years going forward as well. So I think we are more optimistic on small cap going forward, but I think the scenario will change from a broad base to a more selective stock picking.
With this, we will end our Q&A session. Thank you, panel, for your valuable insights. Chirag, any closing comments from your side?
No, I think going into 2024, all three asset classes look attractive, like what we saw in 2023, and all have delivered well in terms of our expectations of those asset classes. 2024, I think, is no different. I think you need to asset allocate. There is a need for asset allocation There are a lot of geopolitical hotspots. There is a fear of a slowdown in the global world. So a diversification and an emergency corpus is necessary. At the same time, India looks in a sweet spot, and therefore there could be more upsides from equity investing as well. So I think asset allocation is again going to play a good role in terms of ensuring that your risk and reward are more balanced, and therefore the 12-20-20-80 allocation, I think, will work well for investors even into next year.
Thank you, Chirag, for your valuable comments. We will be uploading the recorded version of this webinar on our YouTube channel. So to know more about our 12-20-80 asset allocation solution, we'll request all our listeners to visit our website, www.quantumemc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumemc.com, and we'll be happy to answer the same. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.